Hi, fighters. How you doing? This is Travis Witherspoon from Carter Cow Capital, helping you fight for your financial freedom throughout the Forex market through education and automation. Today is a setup day. We're going to go through part 5, which is my simple trading strategy. What we're going to end up doing is breaking down everything that I actually end up looking for and being able to get into trades, what exactly I'm trying to do before I end up entering a trade, and what my mindset is. So without any further ado, let's go ahead and hop into it. What I'm going to end up doing is actually going through the disclaimer, get that out the way. I am not a CPA, which means that I'm not going to tell you whether to buy or to sell. In this video, what I'm going to end up doing is basically teaching you education so you can be able to make an informed decision on your own. And then from there, you can be able to make a decision on if you're going to buy or sell based off of your overall idea from this. Understand Forex involves risk, which means that there's a chance of you being able to lose money or be able to make money. And understand that past performance is not indicative of future results. So with that being said, I want to make sure that I can be able to get this video done somewhat quick because I want to be very thorough with what I'm doing. But I want to be to the point as well. So when I'm planning my overall trade, I look at 5 different things. I look at the economic calendar. I look at top-down analysis. I look at equity management, and then after that, I end up looking at how can I be able to get better at my further trades, and I always evaluate myself at the end once I end up getting done with an overall trade. So while we're doing that, let's go ahead and go through the first thing, which is the economic calendar. Understand this. This is very important on being able to get anything done. The economic calendar shows the most important fundamental news of each currency, and each day is a little bit different, especially within the first week. You'll always see a lot more economic news actually come out, which is very high impact, meaning that it could allow the market to be able to move and swing a little bit more volatile than some other days throughout the week. Typically, the second week of the month is somewhat light. The third week of the month starts to pick back up, especially on Wednesday, Thursday, and Fridays. And then after that, the last week of the month is somewhat kind of in the middle. It's kind of loose, and then you end up going from there. But let's take a look at what that actually looks at, what that actually looks like. You go to fxstreet.com. This is one of the websites that I actually end up looking at for economic information. I actually end up going to this pretty much each and every day to be able to get my information about what's going on with the charts. To give you an example, today is April 14th. If you end up looking at it, we end up having a little bit more low to medium impact news right now. To give you an example, we're looking at the New Zealand dollar has their housing pricing index, and it's basically month after month, and it's based off of the information that happened in March. So you look at the information, it will end up giving you a previous number, which was the previous number that ended up happening between last month. It gives you a consensus number. In this case, it doesn't, but it gives you a consensus number, and that's the number what they expect it's going to end up being. And then after that, they give you an actual number, and that actual number basically ends up telling you if the number was reached or if the number was not hit. So let's take a look at this week to kind of give you an example of what happens when you're in the positive and what happens when you're in the negative. So on Monday, we end up having the business conditions. The previous number in this case was 1. The consensus number was negative 12.9, and the actual number was negative 21. Now, if that was high impact news, you would probably end up seeing the Acer and dollar end up taking at least a huge pip swing toward the downside, at least for a few minutes, while the news is basically being gathered in and people are actually trading based off of that. Sometimes I always say don't trade the news, depending on what the situation may end up being, and sometimes news actually lies. But at the same time, that gives you an idea about what to be able to look for when it comes down to the economic calendar. Now, let's move on to the next thing. The next thing that we end up doing from there is top-down analysis. And simply put, top-down analysis is being able to look at a chart and being able to understand what exactly is happening inside of that chart, so you can be able to get your best foot forward to be able to make a decision on if you're going to buy or sell within any type of trading condition. So I break it down into 3 different things. We look at primary direction, we look at trading zones, and then after that, we use whatever our entry and exit plan is. Now, with the entry and exit plan, everybody's plan is a little bit different. So I'm going to be very vague on this one because Everybody's plan is a little bit different. My strategy works for me. Your strategy works for you. If you want to be able to learn my strategy a little bit more, I will actually end up placing a link in the description below so you can be able to learn a little bit more about it. Now, primary direction. What we're looking for is we're trying to see what direction that we're going to end up leaning to for buying or selling. Now, typically, higher time frames give you the best primary direction and will give you consistent movement so you can be able to understand what exactly you're looking for. So what I have on here is a chart from tradingview.com. If you're interested in being able to learn a little bit more about TradingView and everything else like that, I actually end up placing in a link so you can be able to see it and be able to work from there. But what I end up looking at is the weekly and the monthly to be able to kind of get some overall direction. Right here, I have the monthly on this chart. I have the weekly on that chart. And for people that are just getting started off, you don't have to have it like mine. This basically works for me for being able to understand and kind of break down what's happening with a chart. If you only are interested in only looking at one or two charts, then that's all you have to do. But from a weekly perspective on this, we can see that the weekly has basically ended up going through a downswing, and right now it's in the middle of a downswing as we are looking at it at this particular point. So if the market is showing lower lows and lower highs at this particular point, then that means that more than likely there will probably end up being a better chance of selling and basically trading with the overall trend to give you the best proper opportunity to be able to sell. Now, if the weekly is telling me to sell, then what does the monthly actually end up saying? Or what does the monthly actually end up doing for the overall opportunity? If we look at the monthly chart, we can see the same thing. We have lower lows and lower highs. The market is actually moving through a swing right now. The long-term V extension is at 105.38 for this overall movement, and we can see that the market is basically moving its way down there. So what does that do? What that does is that when you start to look at your overall trading zones, then now you can be able to look for overbought and oversold conditions to be able to trade in the direction that you actually want to be able to trade into. So in this case, we actually said that we wanted to sell. So if we want to sell, then that means that we want to be able to find positions from a selling perspective that we can be able to get in that gives us a high probability chance of being able to create profit. So going back to this chart, let's take a look at the daily. On the daily, when we're looking at overbought or oversold zones, we're only focusing in this case, the stochastic RSI. So when looking at the stochastic RSI, it gives you three different areas that will end up helping you out. And I only want to trade in two, and I want to stay away from the last one. So let's start off with the gray area because the market is basically in the gray area right now. That is known as the no trade zone. Okay, what I mean by no trade zone, that means that this doesn't give you the best opportunity to be able to get the highest or lowest price that you can be able to get into for buying or selling. So there's really no reason to be able to take a trade at this particular point. Now, what does this do? This automatically eliminates some of your bad trades that you end up taking before, because you automatically know that until the market ends up giving me an extreme high price or extreme low price, you don't want to enter the trade. So in this case, what we're going to end up looking for is situations where the market basically ends up giving us a high price because we want to be able to sell. So let's say in this case, if you look at where the market was right here at this particular point, you can see that the market ended up going up to 94%, right? It was above this red line. That means that it gave you a high price to be able to sell. And if you notice right here, the market ended up going up to 1.145 and then slowly start to move in right there. If you're a part of one of our Trade with Travis classes, you actually end up noticing that we actually end up taking a sale right here at this point on March 9th. And since then, the market has been waving itself all the way down, and we know that we have a swing that is going all the way down to 105, possibly to 101. That is about 1,300 pips away. So we've been in this trade for a while, but by being able to spot out where that overbought situation was, then it allowed us to be able to get into this trade and allow the market to be able to move down in this overall swing. So that's in an oversold position. In an overbought position, kind of like what's happening right here, where the market is basically below it, or I'm sorry, oversold position. The top one is overbought, the bottom one's oversold. Sorry about that. We can see that the market basically started to retrace back up. Now, what does this mean when it comes down to if you're trading in the direction for selling? That means that one, that gives you an opportunity to be able to, one, either take profits from that overall position, or what you can be able to do from there is that you can be able to say, hey, I'm just going to let the market rise back up. I know that I'm going to give away some pips, but once it gets back into a high price, I can be able to sell again to be able to have another entry. Now, everybody's trading style is a little bit different. Me personally, this is what fits for me. So just understand that. Now, the next thing that you have to understand is that you have to be able to have an entry and exit plan. Now, typically, entry and exit plans ends up happening on a smaller time frame. So what do I mean by that? If we're looking at this overall example and we're just trying to get an idea about what we want to be able to do from this perspective, what I end up doing is going to a smaller time frame, like a 2 hour, and I'll end up plotting my fibs and kind of figuring out where that overall entry area will end up being. So if we're looking at it right here, we'll say, okay, we have this high price right here at 1.12, where the market is basically end up going up from there. We want to go to figure out what is our new lowest low and see if we're actually working within that fib. So this was the first swing that ended up happening. That swing ended up getting completed. We end up going again, we make another swing. We have another completion that ended up happening right there. Now we end up going through our third swing of the market, and we're looking at it from here. We have this movement to down there. That one ended up getting hit as well. And currently right now, we can see that the market is basically pushing towards this fourth swing, which the market has been, I think the market has broken at this particular point, or it's reacting at this particular point. So if you went and you end up taking entries based off of these four different movements, based off of counter trend line breaks, based off of the market being in overbought or oversold conditions, based off of anything else that you want to do for its overall trading, then you would have been in high probability selling positions, and you probably would have won on 3 out of the 4 of these movements. Now, on this trade right here, depending on where you got in, you possibly could have made something right here. But if you're going forward the long-term movement, then that meant that you probably would have lost on this trade. But your 3 trades going down should have outweighed your overall losing trade that you end up taking within that overall point. Now, from there, after you end up going through that, and after you end up, when you end up deciding what trade position that you want to be able to get into, it is very important to be able to make sure that you have strong equity management. Now, what do I mean by strong equity management? That means that you need to have a plan in place to be able to know how much it's going to end up costing you for your overall risk if you were to lose, your overall gain that you can potentially make, what your lot size is going to end up being, and how that's going to end up affecting your overall trading and what risks you're going to end up applying to it, right? And that includes understanding what the margin is. By being able to have something kind of like our trade tickets and being able to understand how to be able to use that, it allows you to be able to have full confidence in the trade before you end up taking it. It is very important to protect your assets when it comes down to being able to place in trades. So to give you an example, what we have on this screen, if you look at it, we end up having the market, we end up saying that on this first Euro USD trade, we have a $1,500 account. Well, we're going to end up risking 6% of our account. And it's saying that our lot size can be 1.1, which is 1.1 mini lots based off of an 81 pip risk and a 235 pip reward. So our potential risk, our dollar risk will end up being 90. Our potential reward will end up being 261. It tells you, yes, you can be able to take the trade, and that's your margin that you can be able to place in. However, if you look at the New Zealand dollar, United States dollar, we had that same type of trade. Our pip target or pip risk is 50, but our pip target is 100, and it's telling you no. So just understand that sometimes you can be able to take it, sometimes you're not, depending on what your risk to reward actually is. Now, once you end up getting done with that, you want to make sure, while you're having your overall ideas, you always want to make sure that you're having a trading checklist to keep in mind about some of the pairs that you're looking for. Sometimes you can overlook pairs and think that they're in great positions, but they're just not there yet. and 2 or 3 days go by and then you don't look at it at all, and then it makes that move, and then you're upset about that because you said, hey, this was a pair that I wanted to get into. It gave me the right parameters, but I wasn't able to get into it because I didn't pay attention to it. So very important to always be able to have a checklist. It's very important to always take a look at it maybe once a day, be able to understand what a market is. I typically look at my trading pairs 3 times out of the day because I'm a swing trader. So you're talking about 2 in the morning, 8 in the morning, then sometimes right around 5. It gives me an opportunity to be able to understand where the market is going. So by being able to do that, by being able to have a routine, it allows you to be able to be profitable on pairs that you're actually looking for. Now, after you end up getting done with that, it is very important to evaluate yourself. And I'm going to say this again. It's very important for you to be able to evaluate yourself and know where you stand and know how you can be able to improve. The way that I end up personally doing that is by looking at my last 10 trades and seeing what my percentage was on overall success, and look at what was the reasons why I end up taking those trades and if it was in the best position to be able to take. Typically, before I end up taking a trade, I want to make sure that I have a high probability of success, meaning that if that trade is above 65% or more on a probability of success, then that means that I have a better chance of being able to make money initially on allowing the market to be able to swing. Now, we don't know what's going to end up happening with economic news and everything else like that. But as long as you end up knowing that you have a 65% success rate to be able to start off with, then it makes it a little bit easier to be able to pull the trigger on being able to trade. So with that being said, the last thing that you have to understand is this. The fearless people in the market, they end up taking chances that are high probability, will always end up beating out the fearful people. So it is very important to make sure that you always end up, one, evaluating overall trades, being able to put yourself into the best positions by getting good top-down analysis, understand what your equity management is going to end up being. But at the end of the day, you have to be able to click on that buy or sell button, and you have to do it with confidence and know that your plan end up working out with you. Now, hopefully this end up helping you out. If you're interested in being able to learn a little bit more information, what you can be able to do is go to my website, which is Carter Cow Capital / start here, and be able to learn a little bit more information from there. I'm actually pulling it up on my screen right now. If you go to that link, and I'm getting ready to show you left screen. If you end up going to that link, then what you can be able to do is click on your email address, first name, last name, phone number, and sign up for one of our courses that we have. One of the classes that we're pushing right now, and what you end up learning here briefly early today, was the Fibonacci fundamentals. This is something that is a foundation way of being able to learn. All you have to do is just click on that, place in your name, subscribe, and then after that, join one of our sessions that we end up having. We have sessions that end up happening each and every day. Some are pre-recorded, some are not. We always end up hosting private lessons and everything else through there. So with that being said, thanks everyone for being able to hop in and be able to learn my trading strategy. Like always, plan your trade, trade your plan. Everyone, y'all have a good one.